Okay, Lim built a multi-billion-dollar oil empire by selling the same oil twice and forging bank letters to hide 800 million in losses. For decades, Lim Oon Kuin, known to the world as OK Lim, was the undisputed king of bunkering in Singapore. He started with a single truck and built Hin Leong Trading into a titan, a private empire that fueled the world's ships. To the outside world, it was a success story of grit and scale. But beneath the surface, the empire was a house of cards built on a foundation of collateral theft and forced accounting silence. By the time it collapsed, OK Lim had hidden $800 million in trading losses and left behind a debt hole of $3.5 billion. This is the story of how one man's deception blinded 23 banks and dismantled a dynasty. To understand the collapse, you first have to understand how oil trading finance works. In this world, traders don't always use their own cash. They use trade financing. A trader borrows money from a bank to buy oil, and as security, or collateral, they pledge the oil itself. The bank essentially says, we will lend you the money, but if you can't pay us back, we own the oil in these tanks. For years, OK Lim played a dangerous game with this mechanism. He engaged in what forensic analysts call asset multiplier fraud. He would borrow billions from lenders like HSBC, ABN AMRO, and DBS using oil inventory as security. But then he would sell that same oil to other customers without the bank's knowledge. He was selling the bank's collateral. To keep the banks from noticing the tanks were empty, Lim created a forgery network. He provided banks with fake bills of lading, the legal documents that prove ownership of cargo, and forged bank confirmation letters. He even used the same cargo of oil to secure multiple loans from different banks. He was essentially double financing the same asset. Inside the company, the deception was systemic. For over a decade, starting around 2010, Lim ordered his finance department to hide trading losses in a category called Other Receivables. This was a shadow ledger. Because Hin Leong was a private, family-run business dominated by OK Lim and his children, there was no independent oversight to stop him. The board was a family circle, and the internal controls were overridden by the patriarch's will. For a long time, this worked because of the trust trap. Banks didn't physically verify the oil. They relied on inventory certificates, documents that claimed the oil was there. The forensic failure was staggering. These certificates were often printed right in the Hin Leong office with no third-party verification. HSBC, which had $600 million on the line, failed to notice that the same bills of lading were being used for multiple credit lines. The banks weren't auditing oil, they were auditing paper. The turn came in early 2020, when the first reports of the coronavirus emerged in Wuhan. OK Lim made what he called the quintessential Hin Leong play. He bet that oil prices would rise as demand recovered. He was wrong. As the crisis became a global pandemic, oil prices crashed. Suddenly, the lenders demanded margin calls, requests for immediate cash payments to cover the drop in the value of the collateral. Hin Leong had no cash. The shadow losses of $800 million could no longer be hidden. On April 17, 2020, OK Lim confessed in a sworn affidavit. He admitted to the losses and the sale of collateral. The same day, he resigned from the company. But the desperation didn't end with the confession. As the walls closed in, the family attempted one final act of obstruction. On April 13, 2020, just one day before the firm's financial advisor PUC was set to duplicate the company's servers, Lim's daughter, Lim Hui Ching, allegedly instructed an IT manager to delete critical data from the servers. It was a calculated attempt to erase the digital trail of the fraud just 4 days before the company filed for insolvency protection. The aftermath was a systemic shock to Singapore's maritime sector. The collapse destroyed the independent trader model. Banks, realizing that reputation was not a valid metric for risk, pulled billions in credit lines from the industry. This allowed oil giants like Shell and BP to consolidate power, as they were the only ones with balance sheets strong enough to meet new, rigorous forensic standards. Justice eventually caught up. OK Lim was sentenced to 17.5 years in prison for cheating and forgery. He had duped HSBC into dispersing $111.6 million based on 2 fabricated oil sale contracts. Though his sentence was later reduced to 13.5 years on appeal due to his age and restitution, the damage was done. The Lim family, including his children, were forced to file for personal bankruptcy as part of a $3.5 billion settlement. Singapore responded by overhauling its entire industry. They introduced digital bunkering, requiring blockchain-based tracking and mass flow meters to stop double financing. They mandated random tank dips, physical measurements of oil levels, for loans over $100 million. The era of the paper audit was over. The king of bunkering had built his empire on trust, but in the end, he proved that in high-stakes trade finance, blind trust is a liability.